how to master supply and demand zones in trading. In trading, knowing how to identify supply and demand zones isn't just basic, it's crucial. Especially when it comes to smart money concepts, understanding these zones can make or break your trades. After countless hours of practice and backtesting different currency pairs, we've found that supply and demand zones work best when specific conditions are met. Think of these conditions as filters that make your decisions sharper, more accurate, and reliable. In today's video, we'll break it all down for you. How to spot high probability supply and demand zones. Mark them on charts. Understand the psychology behind them. Plus, real-life chart examples. If that sounds useful, don't forget to hit like and subscribe. What are supply and demand zones in smart money trading? Supply and demand zones are areas on a chart where smart money makes its moves, creating zones where prices quickly shoot up or down. These zones represent areas where large orders were executed, leaving a visible footprint on the market. But not every big price reaction marks a key zone. We use 3 golden rules to define a key supply or demand zone. 1. It must create an imbalance. 2. It must break market structure. 3. It must collect or sweep liquidity. When these 3 conditions are met, we found ourselves a prime zone. When big players enter the market, they create imbalances between buyers and sellers, causing sharp price movements. These movements leave behind gaps or inefficiencies on the chart, clear signals of unfilled price levels. Imbalanced movements. These happen when supply and demand are out of sync, causing the price to move rapidly in one direction. This leaves gaps or extreme candlestick patterns, which highlight areas of market dominance. These zones are often where reversals or trend continuations start. Balanced, steady price movements might look nice on the chart, but they're not great for finding supply and demand zones. Why? They lack the power and drive needed to form high probability trading setups. Instead, we focus on the zones created by sharp, imbalanced moves to boost our success rate. For a supply or demand zone to be valid, it needs to do more than just exist. It must break market structure, BOS, or signal a trend shift. For instance, if a demand zone causes the price to break through several structural levels while creating an imbalance, that's a key zone to watch. Entry opportunities: when price revisits such a zone and shows a strong bounce, it's often a good entry point. Avoid overused zones. Zones tested multiple times weaken in effectiveness and should generally be avoided. Liquidity, the hidden key. Another important factor is liquidity. A demand zone becomes stronger if it's preceded by liquidity collection, like when the market creates support levels before reaching the zone. These areas attract traders who place buy orders, giving smart money the sell orders they need to execute their buys. This creates the perfect conditions for a price reversal. How smart money uses liquidity. Stop-loss orders below support equals sell orders for smart money's buying needs. Price bounces higher as sell-side liquidity is absorbed, driving the market upward. Here's how a liquidity grab works on a chart. There's liquidity below a significant low. A candlestick breaks below it, but quickly closes above. This suggests the market might reverse up to the nearest supply zone. If price breaks and closes above the supply zone, it signals a structural change and a true trend reversal. In the next episode, we'll dive deeper into structural shifts and liquidity grabs, showing you how to connect these concepts with actual market setups. If this video was helpful, make sure to like and subscribe. See you next time.